Aren't you tired of giving back profits to the market? You need a trading process that provides you with a leading market condition analysis so you can recognize the tops and the bottoms in your portfolio. TechniTrader has been helping traders achieve their profit targets for more than 24 years with a complete trading methodology that you won't find anywhere else. Check out the new online trading courses at technitrader.courses.
Hi everyone, today we're going to talk about investing in penny stocks or lower price stocks. A lot of times if you're just starting out and you haven't been in the stock market very long, you don't have a lot of money to invest in stocks. Maybe you have as little as $500 or $1,000 or $2,000 or $3,000 you've set aside, but you still would like to invest in stocks or trade in stocks. First of all, investing in stocks means that you're going to hold it for 1 year to maybe 10 years. And then sell it. You want to sell as the business cycle ends, and sometimes that business cycle is only about 4 or 5 years because the stock will retrace anywhere from 50 to 80%, and then you'll lose all of your investment. It takes a long time to recover sometimes also from a business cycle. All businesses grow to a certain point, expand too much, then they contract. Their business cycle goes from a peak to a trough, and then they start the cycle all over again as they reinvent. That's because every product or every new service that they offer has a life cycle. There'll be the new adopters, the early adopters, the secondary adopters, the mass market coming in to buy that product, and then it slowly reaches market saturation where everybody who would want to buy that new product already owns it, and all they have is enhancements, and that will not have the company grow as much as it did when it was first new product. As an example, Apple iPhone, brand new product. They grew exponentially over several years. But now everybody who wants to own an Apple iPhone already owns one. And so they're not going to have that big growth because what they have is young people who grow up and buy iPhones when they're teens or preteens. But they don't have that huge growth of all of the mass market not owning that product, and now they want to buy it. So they reach market saturation at some point, and if they don't reinvent and have some brand new product, if all they do is enhance the product they have, at some point that company is going to peak, and then its business cycle is going to go down. It's going to have lower revenues and then lower earnings and so on and so forth. So when you have a little bit of money to invest, you have to be very, very careful with it because you have less money. The less money you have to invest, the more you have to be conservative. And unfortunately, a lot of times when people have a small capital base, they often take greater risk than those who have millions of dollars to invest. It seems like when you have a little bit of money, you're willing to gamble it because you don't understand that you should not gamble it. You should be much more conservative of what you invest in or trade in when you have a small capital base. When you have a very large capital base, then you can take higher risk because you can stand the loss. And everybody has a loss at some point. There is no one that has never taken a loss. That's everyone. Warren Buffett in the 80s, early 90s was losing everything because he kept investing in silver. It was as if it was a broken record. He almost lost everything. Everybody takes a big massive loss at some point because they get overconfident or they don't pay attention to what's really happening and they get too emotionally involved. With a small capital base, a lot of times people will be interested in penny stocks or lower price stocks, or even options. Today we're going to talk about penny stocks and lower price stocks. We'll talk about options on another day. If a stock is a penny stock, that's a stock that's trading for $1 or less. It's probably not trading on the listed exchanges. Stocks that are listed are stocks that meet a certain criteria for the listing. The New York Stock Exchange has a specific listing requirement that all the companies must meet and maintain because they can be delisted if they fail those requirements. Same with NASDAQ. Now the two are different. New York Stock Exchange has a much more demanding, restrictive requirement list, and NASDAQ has a slightly less restrictive list. So the stocks that are listed on the exchanges can be delisted, meaning they come off of the listing, or they can be listed. A lot of penny stocks, stocks that are under $1, are not listed because one of the requirements of both of the exchanges is that they must maintain a dollar value, $1. If they go below that, then they generally are at risk of delisting and are told and advised of this from the exchange that they will be delisted if they don't correct this problem. But you will find some penny stocks listed temporarily as they go through this process. So if you see some stocks that are less than $1, that stock is at risk of being delisted. And that's a risky thing. You don't want to be in a stock that's delisted, because then it's a pink slip or a bulletin board stock, and there are far fewer people who are buying and selling that stock as there are people who are buying and selling listed stocks on the exchanges. There are about 5,000 or 6,000 listed stocks on the exchanges nowadays. That can go up and down. It can be as low as 5,000, can be as high. I've seen it as high as almost 10,000 in years past. Then you have your bulletin board stocks, and there are anywhere from 10,000 to 20,000 publicly traded companies on the bulletin boards. These are over-the-counter exchanges, so it's broker listed to broker, which means it's not as liquid, which means it's harder to buy at a good price with the right spread, and it's harder to sell because not as many people will want to buy it. Pink slips have anywhere from 10 to 30,000 publicly traded companies as well, and these are also over the counter, and they're very low price stocks. A lot of these companies came to market, IPO'd, and they may not have ever been listed. That's the first thing you should check. Have they never been listed? If they never were listed, that means the company never qualified for the New York Stock Exchange or the NASDAQ. That's a bad thing, because that means that there's something wrong with the company. The other thing you should be checking is you would really want to stick with listed stocks. You really do. I know that you're looking for really low prices, or maybe you're thinking, oh, these penny stocks, I hear that this stock went from 25 cents to $5. I really want to get that kind of thing. Well, that's rare, and it's very risky, and it doesn't happen very often. In all the years I've been teaching, I've only heard about 3 people make money on penny stocks like that. So you have to be careful. I would advise using the listed stocks because they are listed, they're more liquid, meaning there's more people trading them, and it makes it easier for you to buy and sell it at a good price and control that. The other thing you need to know is that the bulletin boards and the pink slips don't have the requirements for all of the reporting of earnings and all of that and all the information that is important so that you know whether this company is actually growing or if it's in its contraction phase. It is also best to always check stock charts. When you're checking a stock chart for a penny stock, you not only want to look at the daily chart, but you want to look at a weekly chart and a monthly chart. What you're looking for is, has this stock ever been higher than the price it is right now? Or has it always been in a low price range? Some stocks have been trading between 50 cents and $1 for 20 years. That stock isn't going to do anything. And a lot of people get fooled into this because they'll get a call from a broker or somebody that's trying to sell a bulletin board or a pink slip because they want to make money off of you buying it high. And they'll say, oh, buy this stock, it's going to go, it's going to go, it's going to get some sort of approval or a hot new product coming out or whatever. And you get all excited and you think, oh, I'm going to be wealthy, I'm going to be wealthy. So you buy the stock and then you lose money on it. And you go, stock market's all fraud and corrupt and bad. It's not. It's because you didn't do your homework. Just because somebody recommends a stock or calls you or your buddy buys a stock doesn't mean that it's right for you. You have to evaluate a stock based on your risk tolerance, your capital account, and what you can trade and what you know about the stock market. If you don't know very much, then those tips are going to be very risky and you're going to lose money most of the time. So penny stocks don't have the qualifications to be listed, and so they're lower price range stocks. And you want to check the stock charts to make sure that they have moved up. Now, sometimes a company has been listed, gets delisted because it falls below $1 value and stays there for a long, long time. That happened after 2002. A lot of companies just plummeted in value down to less than $1, and so they were delisted. A whole bunch of them, thousands of them. And one of the reasons I knew that the market was bottoming at that time was because all of a sudden a whole bunch of stocks that had been delisted were relisted. That means those companies had earned the right to be listed again on the NASDAQ and the New York Stock Exchange. So now they were listed again, and a lot of the professionals were buying them because the company had finally turned around and their business was thriving, and they had grown through the recession of that era and the stock market crash, and now they were ready to be viable companies again. You want to look at the stock chart on a weekly or monthly scale because you want to see what was the highest price it ever was before. Where is it right now in relation to that price? Is it below the highest price it ever was? Or is it above the highest price it ever was? Because if it's above the highest price it ever was, that's a risky buy. That means you're paying too much for that stock. You always want to buy stocks when they're near their lowest low. not in a downtrend, but near their lowest low. And the only way to tell that is to learn the bottom formations that form in our modern automated market. Now, there are a lot of technical analysis books out there that teach bottoming patterns, but a lot of those bottoming patterns don't even form nowadays anymore because of the changes to the order and routing structure of the professional side, who can control their entries much more keenly than they did in the early days when technical analysis was first created. So the older technical analysis books have old style bottoming formations that they teach you, but you may not find any of those in the charts that you're looking at. So with a penny stock, you want to know if it's in a bottoming formation, and you want to know if the company is growing, and you want to know how far that stock can run. And a good way to tell is to look at its all-time high. If it is a company that at one time was $500 and it's now $2, and a really strong bottoming formation is developing, and you find out that the company has reinvented, gotten rid of a lot of surplus middle management, it's tightened its things, gotten rid of a few divisions that didn't work, that's a company that might be a long-term investment, something to consider. But if your penny stock or your dollar stock is at an all-time high and has been running up for the last couple of weeks on speculation, if you buy that stock, it's more than likely that you'll be buying into a selling for profit mode by the professionals who got in early because they saw that this stock was being mentioned on stock tweets or stock twits. So they bought the stock, pushed it up, got everybody all excited, sent some tweets and twits out there. Oh, this stock is so great. Oh, you should buy this stock. And so everybody's rushing to buy this stock. And lo and behold, it crashes as the larger lot traders sell against the smaller lot buyers. So you have to be very careful. There's a lot to learn about stock trading or stock investing. And you want to be careful. A lot of people say, oh, if you just buy this stock, if it goes down, you just hold it. Well, you may be holding it for 10 or 20 years before it moves up. It may never move up again. You have to be careful. If you have a small capital base, you need to be much more conservative and have far more information than someone who has a really large capital base, because they can afford to lose a little bit of money. And they naturally are going to be more conservative because in order to acquire that much wealth, they had to be very stringent on what they did and what they spent money on. A lot of times, a smaller capital base will be so eager to make money that they don't stop and think before they buy. And you have to be careful. Otherwise, you will lose your money. No doubt about it. The market doesn't care. It doesn't care about you being a small lot investor, a small capital base, whether you want to buy a penny stock or a $10 stock. It doesn't care. It is almost fully automated now, with about 80% of all the activity running through computers. So there's no human there going, oh, I'm going to buy this stock or sell this stock and rip off this little guy. That doesn't exist anymore. So if you hear somebody telling you that, or somebody's teaching you that, they don't know what they're talking about. They're teaching you old, outdated information. The biggest risk you have is a lack of knowledge. You don't have enough information to make the proper decision. You don't understand your risk. You don't understand where the stock is in its cycle. You don't understand where the business is in its cycle. And all too often, you get so excited because you think you'll make a lot of money on the stock, and the guy on the phone or your friend or the tweets or twits are so exciting, you think you have to buy it. If you think you have to buy it, if there's an urgency to buy, then you shouldn't buy it, because that's a sure sign that the market has put that stock in a speculation mode, and it's at risk of a topping action or a correction, because the large lots traders who bought it earlier are going to start selling as soon as the smaller lots start buying. You have to be very careful and know what you're doing, and not just run in to trade and buy stocks. Right now, there are a lot of new investors and new traders all rushing to buy stocks without any idea of what they're doing. They read a few articles on the internet, they watch a few videos, they listen to the stock tweets and stock twits, and they go on and try to figure out what they want to do and what they want to buy. And they're racing in with pure emotion, and they're going to lose their money, and then they're going to be so angry. And you shouldn't be angry. What you should have done was stop, get a good education, understand what you're doing. So if you haven't been to our website, come and visit us. We are only an educational company. That's all we do, is teach people about the stock market, how to invest, and how to trade stocks. That's our specialty. That's all we do. There are very few training companies that are strictly educational. A lot of the training out there is based on a broker system or a charting software system, or it is some other kind of system that they're making money not on the education that they're giving you, but on the system or the brokerage or the software or whatever they're trying to sell you. They're trying to sell you a product. So their interest is in getting you to buy their product, not teaching you how to be the best trader or investor you can be. All we do is educate, so our focus is on making sure that you are successful as a trader or investor. Not about how many orders you put into the brokerage system or what price of software you use or whatever. So our goals are completely different than what you'll find elsewhere. Our goals are to make sure that you're a highly successful, consistently successful trader and investor. That's what makes us successful. Your success becomes our success because most of our sales are related to someone who tells another person how great and wonderful our education is and how well they have done in the market and how much they know and understand now that makes sense of the market. A lot of people don't understand the market, but they go ahead and invest or trade anyway, and that's a very risky proposition. Come visit us at technitrader.courses, and then if you feel that how we teach is right for you, check out our course pages, download a syllabus of the course which gives you details of every aspect of what we teach. Our support is the most extensive anywhere. No one has the type of support that we have and that we provide to each and every student. We're not just chomping out thousands and thousands of cookie cutter traders all trading the same way. We customize our support and our training to fit your goals and your needs, your capital base, your experience level so that you can become a consistently successful trader or investor. I'm Martha Stokes, and that's the radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.